Good morning, ladies and gentlemen. First of all, I would like to thank SteelOrbis and EUROFER for inviting me to speak at the 2017 Spring Conference here in Budapest. Now, I'm quite sure that most of you already made a short walk along the river Danube and admired the magnificent buildings at the Buda River side. Under the current conditions of sunny weather, that is really giving a very clear and magnificent view of the other side. Unfortunately, when it comes to telling something about business conditions in Europe regarding the economy or the steel market, things are definitely a bit less transparent. And it has to do with all the risks and uncertainties which are there. And actually, I don't think I have to name them all to you, but because they're quite obvious. It's about a Brexit, coming elections in Europe, in France, Italy, a lot of, let's say, the populism in Europe is related to the lack of leadership in Europe. And that's clearly an issue. To some extent, I think Europe should reinvent itself. Plenty of geopolitical risks around the world, Trumponomics, protectionism, isolationism, trade barriers. We've seen a period of strong globalization. What could happen is that the world is becoming regionalized again. And then the weakness of the emerging economies. So a lot of risks and uncertainties. But surprise, surprise, if you look at the indicators for Europe, they are at a multi-year high. And no matter what indicator you take, whether it's EU economic sentiment, industrial confidence, retail confidence, consumer confidence, from the European Commission monthly surveys or the market PMIs, we are currently at very, very strong levels of confidence. And that's, of course, a positive start of 2017. But also when it comes to hard data, the situation is quite good. EU GDP growth last year was around 1.9%. Strong growth over the year, very steady growth pattern of around 0.5% in each quarter. If you look at the drivers of growth, basically private consumption. Unfortunately, investment and exports have been lagging a bit in terms of the actual growth rate. What we've seen lately, and that's the bottom chart, is some acceleration in industrial production growth, which could signal that things are, let's say, picking up some steam lately. Probably has to do with the fact that thanks to the weak euro and the increase in dynamics in the developing countries, exports have been also increasing. Basically, all the other indicators for the economy, such as the labor market, as already indicated by previous speakers, are also quite good. So I think the conclusion for last year and for the start of this year is definitely the EU economy is performing rather positively under challenging conditions. Let's face that. Looking forward, as you see in the graph, and looking at the annual growth forecast for Europe, we've become, let's say, a little bit less optimistic in terms of economic growth. Now, this forecast comes from January. We revised it again in April. My personal feeling is we probably become, again, a bit more positive, given the fact that indicators are good and hard data are quite good. But nevertheless, I think there are two elements. There will be a continued rise in private consumption, but the tailwinds we had in 2016, low inflation and extremely low energy prices, that impact is clearly fading. And then investment. Investment is really the one element in economic growth which strongly depends on confidence. And as it is, there's still quite some uncertainty, as I've shown before. On the other hand, if you look at the fundamentals for investment, things are quite positive because of the the continued easing in financial conditions. We see a very accommodative ECB monetary stance. The global economy is probably strengthening as well. On the other hand, for Europe, there are quite some economic and political uncertainties. And that means that probably there will be a very moderate deceleration in economic growth in 2017-18. The risks. I think the two key players are in the bottom photograph. It's clearly Trump and Mrs. May. The Brexit. On Wednesday, the UK government will announce or invoke Article 50, which will be the start of the two-year negotiation period of a new relationship between the EU and the remainder of the the UK and the remainder of the EU. I think one very important issue will be how strong, how firm the remaining countries in Europe will be on the price that the UK will have to pay for leaving the EU. If the price is not too high, it might encourage other countries in Europe to follow the same track. Particularly France, I see a risk. Italy, given the fact that in those countries there will be parliamentary elections. And it could be that in those countries populism is really, will be winning the presidential votes. Then Trumponomics, already indicated by a previous speaker, there will be positive short-term effects, particularly for business, the corporate sector in the US. For Europe, I think let's wait and see what happens with protectionism potentially developing into isolationism of the US. Anyway, it's not going, and as we all know, it's not good for international trade if that would be the case. I'll move to the next slide, which will deal with the steel using sectors in Europe. The overall picture is actually quite positive. If you look at the forecast for the automotive sector, which has been doing rather well for already 3 years or so, we expect a continuation of strong growth going forward. First sales figures for 2017 are again quite positive. Continued growth, less than previous years, but that makes sense because there's also a base year effect. On the other hand, export markets, there's definitely some uncertainty. Apparently the US is at a sales peak. There we also see in the automotive supply chain already impact of more protectionism. And we see increasingly in developing countries that are building up their own capacity. So I'm not so sure about automotive exports, but there will be continued growth in automotive. Then the construction sector. I'll come to that later. I have a separate slide on construction, but we're quite positive for construction in Europe. Mechanical engineering, strongly depending on investments, strongly depending on exports. It's a sort of mixed bag of fortune for capital goods demand. I think the two elements which could act as a showstopper for this sector is definitely elections and Brexit uncertainty, particularly this year. I'm a bit more positive for 2018. And then metal goods, also a sector which has a rich variation of subsectors, depending on other sectors such as construction, such as automotive, engineering, also quite positive outlook. And if you look at the top graph, there is some improvement in terms of the order assessment at the start of this year, particularly the red line is picking up, which is mechanical engineering. So apparently companies in that sector have become a bit more optimistic about the outlook. And you see the continued strength in the green line, which is motor vehicles. The bottom graph shows actually where we were in 2016 and the expected trend going forward. You see again the green line is clearly outpacing the others, which is automotive. Automotive has been the star performer in Europe and will continue to do so. The other sectors, there's much more moderate growth. And as it is, only automotive is now at a higher level than in 2008. As I said, I had a separate slide on construction. Last year, we unfortunately saw a slight decline in output. That had to do with the fact that there were diverging trends between Western Europe and Central Europe. In Western Europe, there was continued growth of around 2%, driven by the housing sector, particularly in Germany, in the Netherlands, in Sweden. This sector is doing very, very well. Of course, it makes sense because putting your money on the bank doesn't bring any revenue. Interest rates are non-existing or extremely low. So investing in bricks in Europe is definitely the best way to do something with your money. And Central Europe, on the other hand, the key driver is their infrastructure building. And unfortunately, and Central Europe is basically Poland, Hungary, Czech Republic, Slovakia. In those countries, there was a strong decline in civil engineering activity. It had to do with the fact that the European Commission decided to halt the flow of EU funds going to these countries. Particularly Poland was affected. And overall, as I said, there's a slight decline in activity in 2016. Now, for 2017-18, we do expect an acceleration in growth. It has to do with continued growth in Western Europe, where we see a continuation of a strong residential sector, both new residential buildings, but also renovation, modernization, unfortunately, less steel intensive. Also the fact that there's a migrant inflow that will stimulate social housing investment in several countries with an improved budget deficit situation. We also see increased investment in non-residential activity. And then also in those countries, slowly but steadily, there is investment in infrastructure in Western Europe. Aimed at debottlenecking economic, let's say, economic bottlenecks in the which lead to a lower than expected economic growth in Europe, such as in IT, in energy, in roads, in railways. That will help getting economic growth on a growth track again in those countries. And then for Central Europe, there will be the availability of EU funds again, which will lead overall to an EU output in construction of around 2% this year, but growing to almost 3% in 2018. So that's a rather positive picture for the EU. Now the steel market. Let's have a look at 2016 first. In this graph, I've combined three elements. The blue bars is the increase by quarter and year on year of demand. The red bars are imports, and the green bars represent the market share of imports. Now, as you can see, we've seen a very modest increase in demand, steel demand in Europe. On the other hand, if you look at the red bars, we've seen a continued growth of imports, and it's not the first year that we've seen imports grow rather strongly. It's actually the third year in which imports have seen a very, very significant increase. And that leads to market shares of imports in the total steel market in Europe of around 25%, which is a large share, I can tell you that. And that means that European steel companies have actually not been able to benefit from the rising trend in steel consumption in Europe. At the same time, due to protectionism around the world, overcapacity, competition has been very, very fierce in the international steel markets. And we've seen export deliveries falling by 11% last year, which is a reduction of more than 3 million tons annually. So both on the domestic side as on the export side, the EU steel sector is actually suffering. The forward view for steel demand in Europe, we're actually, let's say, moderately positive for steel demand going forward. There will be continued growth, not really spectacular, because the EU is a mature market and don't expect anything higher than 2% for steel demand growth in Europe. However, for long products, given the expected trend in construction, I'm definitely more positive. Also, the fact that economic activity and activity in the steel using sector is picking up further, there will be the need for slightly higher stocks in the supply chain. So overall, the outlook for the European steel market is definitely not bad. The key concern really remains imports, because even if there's a gradual improvement of the market, but EU steel firms do not benefit, then of course we're not really gaining that much. The last slide is an overview of the key takeaways on the economy. Sentiment at a very high level, multi-year high, hard data positive, and all in all it points to the European economy being on track for further growth. I think from the political side within Europe we have to expect the key risks, and under these conditions, to deal with Brexit, to deal with populism, we really need strong leadership, and unfortunately one can be clear that until so far strong leadership has been missing in Europe. Clearly there's the risk of fading global support to free trade. That's to do with Trump being the newly elected president of the United States. Then the steel using sectors, construction a positive outlook, automotive continued growth, but growth tapering off a bit. And then mechanical engineering, this year probably still not really growing significantly, but somewhat better outlook for 2018. And then the steel market, unfortunately imports at a multi-year high last year, final quarter, but the expectation of continued growth in steel demand in Europe and a relatively good performance of long products. The key concern remains that the further recovery of the US steel market will be hampered by trade distortions. And this is where I would like to end my presentation. And if there are any questions, I'm happy to answer them.
Thank you very much. Any questions for Mr. Vermeij from the floor? I may have one, if you allow me. I have been hearing about this potential possible carbon tax on steel products in Europe, and I read Mr. Lakshmi Mittal also offered his support on this tax. Could you please help us understand a bit more on this issue?
I'm not the climate change or environmental expert of EUROFER, I must confess. I'm not sure where Lakshmi Mittal is referring to, whether there is, let's say, of course there is already, the ETS system is in place. Now it could be he's referring to a border tax, and that's something else. Now I know that within Europe some people would be in favor of a border tax. On the other hand, it would be a very complicated situation, because you have to find the right balance between the two systems. The ETS system is already there, is currently being revised. And if there would be an additional border tax, that would only complicate things even further. So let's say my perception is that the European steel industry has to remain very active in getting an EU ETS system after the revision, which works for the steel sector, which really limits the damage which could be done in terms of the actual cost and the impact on margins in the steel sector. And the idea of a border tax could be interesting, but let's see about that.
Okay, thanks very much. Any other questions from the floor? Can we have the microphone? Sorry, I didn't see. Just give me the microphone.
Thanks for the presentation. I wanted to ask, we've seen in one or two of the anti-dumping cases, particularly last year, some higher duties applied to import of certain steel products. Is this a direction that you expect the European Commission to proceed with? Some people said at the time maybe adopting a more American stance to the rate of anti-dumping measures. Is that something that you expect in the long term, or do you think this is a short-term sort of sticking plaster, and long-term we should expect to see sort of more liberalized trade on steel products?
The level of the duties is, let's say, only meant to repair the injury which is done by the trade distortion. Nothing more, nothing less. So in each case, the European Commission, and that's why they take such a long time to come to these eventual anti-dumping duties, that's currently around 16 months for any trade case, they really take their time to calculate very thoroughly what the impact of the trade distortions are, the dumping, on the profit margins of EU steel producers. And then they repair that damage. And that's a system which is very different from what happens in the States. There is, let's say, that's clearly a warning signal. Listen, you shouldn't enter the US market with your products which are being dumped at those prices. So we set anti-dumping duties of 300 or 400%. That never happened in Europe. I think the highest margins we've seen so far, the highest anti-dumping duties we've seen so far, I think it's for quarter plate, around 60% or so. But that is really only meant to repair the damage. And so we're not getting any beneficial effects from those anti-dumping duties. So there is no, let's say, political stance or let's show them something around the world. It's simply repairing the damage done.
Thank you.
And that will remain the policy of the European Commission. I'm quite sure, because that's the system.
Thanks very much. I guess no more questions. So thank you very much, Mr. Vermeij. Very nice presentation.